In this video, I'll be going over our accounting work together, problem 17-4, on the topic of analyzing financial statements using financial ratios. This is from our Century 21 Accounting Textbook, edition 10E by Gilbertson, Lehman, and Gentene. So all credit to them for this problem and for the text that it's in. So, as I suggested before, we're analyzing financial statements using financial ratios. So here's what we know to fill in our form up here. We know the net income after federal income taxes, number of shares outstanding of our stock, dividends per share, market price, quick assets, current assets, and liabilities. So number one, A, we're going to calculate earnings per share, dividend yield, and price earnings ratio. So let's start out with our earnings per share. Our textbook tells us that earnings per share is net income after federal income tax divided by number of shares outstanding. So it's 186.18 divided by 40,000. 3.70 or $3.70 earnings per share. The next one is dividend yield, and our textbook says that it is dividends per share divided by market price per share is our dividend yield. So dividends per share equals 248 divided by market price per share, 37.90. 6.54%. And finally, the price earnings ratio. This one is market price per share divided by earnings per share. So equals market price 37.90 divided by earnings per share, which we just calculated here, gives us $10. Or 10.2. I don't really want that formatted in dollars, actually. We'll go like that. 10.2. So, is it an increase over the prior year? $3.70 to $3.26? Yes. Dividend yield, 6.54 divided by, or compared to, 6.63%? No, it's not an increase. And PE ratio, or price earnings ratio, 10.2 is greater than 9.5, so yes. So what would our evaluation be? Well, probably we would want to know the percentage that EPS increased by. Would be my most likely guess. So let's see, equals this minus this. And then we'll just divide by the prior year again. So it's an increase of 13.5% or 13.6%. So I would say EPS increased by 13.6% over the prior year, a favorable trend. And if we need to increase the size of this, we will. Next one, dividend yield. It's really a very small decline. It's almost the same. So it's really not that big of a deal, but it is a small decline. So I would say a small decline in dividend yield is an unfavorable trend. We'd want that to increase. And how about price earnings ratio? So we know that having a higher PE ratio is better and indicates that our financial markets are valuing the stock better, I guess. So let's just say the increase in the PE ratio indicates that financial markets have placed a higher value on the stock, which is favorable. We want that. Okay. Let's do number 3 and 4 now. Calculate working capital. So we'll start there. The actual ratio this year. Working capital is defined as current assets minus current liabilities. So current assets are 604,984 minus current liabilities 418,493, 186,491. Was this within our target range? 186,000 does fall between the 150. So, yep. And the 200,000. Current ratio. The current ratio is calculated as current assets divided by current liabilities. So, if I'm undo whatever I did, and just copy this, current assets minus current liabilities. I'm going to paste it here. Didn't like that. We'll Control V paste, and I'm going to change this to a divided by. And I get 1.45. 1.45 is outside or below the acceptable range that we've determined. So that is not good. It wouldn't be favorable. We would want that to be higher. But how's our quick ratio? Remember, quick ratio might be an even more conservative estimate of whether or not our company is going to be able to pay their bills. And the quick ratio is quick assets divided by current liabilities. So we have quick assets of 484,943 divided by current liabilities of 418,493, 1.16. So our company is deemed that anything between 1 and 1.5 for quick assets is good. So quick assets, generally just your cash, petty cash, accounts receivable. So there we go. That is a quick analysis of some financial ratios for a company. And you're going to do a very similar problem on your own on the next tab over. So, good luck. You guys have got this.